येत नाही. तर पेन ते इथे येत नाही. अच्छा. स्क्रीनचा अजून वरती पाहिजे. थोडं अजून पाहिजे खाली. हे बघ, हे एस हे कट. Okay, am I audible properly? Am I audible properly? Hello?
No, it will be faded. The video.
Video. त्याला आता काय करता येईल. Video means it get blurred or what? Okay, so we will wait for another 2 minutes and then I'll start.
Okay, sir.
Okay, so we start now. Today we start with the intangible asset. Okay, so most common intangible assets are patents, copyright, franchises, okay, and goodwill. Okay, so like this we can acquire with a certain contractual agreement or we can self-generate. Okay, so keep in mind we are not we never recognize the intangible asset if it is self-generated. Okay, so if we acquire or purchase, okay, so this three we can acquire or purchase, okay, with a definite life. Okay, definite life means either I can use the patent for 10 years. Okay, so that is basically the contractual agreement. Okay, and then the life of this patent is 10 years. It is like this. Okay, or the franchisee I can use for say for the 5 years. Okay, like this. Okay, so here also if someone buys the any intangible asset, so there are two things. One is basically the contractual life. Okay, and the second is legal life. Like if I buy the right from the government for 10 years, so I can utilize that right for 10 years only. Okay, even if I make a contract with third party for a 15 years, but the right for that intangible asset, because the legal life is 10 years, so we need to restrict to the 10 years only. Okay, so whenever I mean, I'm right now I'm talking about the intangible assets having a definite life. Okay, so if legal life is 10 years and the contractual life 12 years. So you need to amortize the expenses whichever is less. So here 10 is less, so we need to amortize the expenses on a 10 years. Okay. So if the legal life is 12 years and the contractual life is 10 years, so you need to amortize the expenses on a contractual life. Okay. So that you need to keep in mind. Amortize, what is amortization basically? It is just like a depreciation. So see, if I'm using this asset for 10 years, so whatever the amount I paid, okay, amount I paid to acquire this asset, okay, to acquire, okay, that I need to charge off to P&L, means I'm recognizing expenses in every year over the 10 years, or okay, so that is basically the amortization. Okay, when you acquire the asset, you are going to capitalize it. But as you started to use it, you need to charge off to P&L portion of that amount. Okay, so if I acquire the asset for 10 years, then I need to charge off the cost in 10 years period. Cost in 10 years. Okay, that is basically the amortization. Okay, so first thing, basically, like whatever may be the acquisition cost, okay, that we need to charge off over the legal life or the contractual life, whichever is less, that you need to keep in mind. Okay, now the carrying amount. Okay, so what is basically the carrying amount? Acquisition cost less amount charge off to P&L, or I'll write amortize. Okay, so whatever may be the difference that we need to reduce, this is my carrying amount. Okay, so every year, say for you acquired a patent for 10 years, for 10 years, okay, say the cost of acquisition is 1 lakh. Okay, so every year you need to charge off 10,000. Okay, because you acquire it for the 10 years, so you need to charge off entire cost of acquisition in a 10 years time. So per year cost is, per year charge off or amortization amount is 1 lakh cost of acquisition divided by 10. So means whatever my utilization period. Okay, so I need to reduce 10,000 for after 1 year. So my carrying value is 90,000 after 1 year. After 2 years, again I am going to charge off next 10,000. My carrying value after 2 years is 80,000. Okay, so this way you need to consider. Okay, any doubt here? So that is carrying amount. Okay, now we talk about the goodwill. Goodwill mostly has an indefinite life. Okay, so first, how we calculate the goodwill? If we acquire the goodwill in a business combination, okay. So what happened here? Like say for I acquire a particular business with a 10 lakh. Okay. But the asset which I got, net asset means asset minus liability. So it is asset minus liability means I took over existing asset, okay, and existing liability. The cost of asset minus liability, fair value, I can say, fair value, not book value, okay, which is 8 lakh. Okay, so I got the benefit of 8 lakh, but I paid 10 lakh. So whatever the excess I paid, this is my goodwill. Okay, so we will see this in more detail, but you can understand whenever I am paying excess, okay, so that is my goodwill amount, which I am paying the goodwill amount. Okay, so this way we need to calculate. Means purchase consideration or the price I supposed to pay to acquire the entire business is higher than whatever the net asset I am receiving. Okay, net asset is asset minus liability. Okay, so whatever may be the difference, that is basically the goodwill. Okay, goodwill we are not amortize, not amortizing. Okay, method we will see. Okay, we are not amortizing. Okay, so every year we are maintaining the same goodwill. Okay, but we need to test the impairment is basically means I have an I mean, so now I acquired the business, I am running the business. Okay, after 2 years what I find means whatever the business I acquired or purchased, after 2 years what I find, the net asset of the business is say for 8 lakh, but whatever the cash flow I'm getting, okay, from that business, if I discounted, okay, so then in that situation, the value of business is 6 lakh. That means in any situation when I'm closing my business, I may end up with the loss of 2 lakh. Okay, so that is basically, if I mean, what does it mean? I cannot recover full amount of my asset. Okay, I can recover only up to 6 lakhs. So 2 lakh I need to charge off immediately or impair. Okay, in my books, I have already 2 lakh stand as a goodwill. So instead of reducing the value of the asset, I will first charge off this amount against goodwill. Okay, so that is, see, say for like every year I am getting any amount you can consider, like 1,25,000 for next 5 years. Okay, if I discount it, it is just an example. Discount means what happened, we just understand 1.1. So if it is, I'm reducing the value of my future cash flow. It is like this. So 1.1 square, okay, cube. So this way I'm discounting it, okay. And after discounting, if I suppose to get the value of this cash flow 6 lakh, okay. So what does mean? The present value of my business is 6 lakh, okay. But I mean, whatever may be the, as per the balance sheet, my asset stand at a net asset stand at a 8 lakh, okay. So anyhow, I am going to bear the loss of 2 lakh. So what I am doing, I need to bring it my asset valuation to the 6 lakh, okay, so that I can charge off my whatever the loss I am generating in a future, that I can charge off today. Okay. See, conservative basis of accounting, what it says, income you should defer, okay, if required, okay, but loss you should charge off. Okay, so that is basically as and when you feel the loss may happen. Okay, so that is basically the conservative basis of accounting. Okay, so 2 lakh we need to charge off, okay, because my asset value may go down. Okay, and if I have a stand, means whenever you are charging off, okay, or impair the asset value, you need to first offset against the goodwill amount if it is available. Okay, so in this situation we have a goodwill of 2 lakh. So what I am going to do, whatever may be the asset charge off, that I need to apply to the goodwill. Okay, if there is no goodwill, then on the pro rata basis I need to reduce the value of the asset, like this. Okay, say for like machine, building. Okay, if goodwill is not there, and building and other asset. Okay, and this is basically the machine is 2 lakh. Okay, building is 4 lakh, and the other asset is 2 lakh. Okay, now we need to bring it to 6 lakh. So what I'm going to do here, like 3 lakh, 1,50,000, and 1,50,000. Okay, so proportionately means this 8 lakh reduced to 6 lakh. Okay, this way I'm doing it. But here, if there is a goodwill is stand, okay, so here it is 2 lakh. Okay, so in that situation, I mean it is 8 lakh. So you need to keep this value as it is, and only you need to make it 0. Okay, so this way we are reducing the value of the goodwill. So acquisition method we just saw. Okay. And the equity method is, I mean, it is more or less the same concept. In acquisition method, what happened, like when there is a, how I can say, mm, so like you are acquiring the business, not business, I can say asset, acquiring the asset. Okay. So in that situation, whatever may be the net asset you are receiving, okay, and whatever the excess amount you paid, that you need to consider as a goodwill. And in equity method, it is basically whatever may be the share valuation. Share valuation means where you are doing a share deal. Okay, share valuation, whatever the excess amount pay to acquire the share. To acquire the share. That is basically the goodwill. Okay. So I mean this may not be the relevant here, but I'm just trying to explain. See, in asset acquisition method we already saw. Okay, I mean whatever may be the net asset value and whatever the purchase price we paid, that is basically the acquisition method. Okay, in share equity method, what happened? Investors getting shares against the shares of the old company. Old company. Okay. Okay. So whatever may be the old share value and the new share value, and the new share value for the investor. Okay. So there is a gain actually. Means what happened? Old share value is 10 and the new share value is 12. Okay, for investor it is a gain, but for company, means who is acquiring the asset, it is a goodwill. So this way we need to calculate. Okay, so goodwill is basically the excess stock purchase price over the fair value of the net asset acquired. Okay, so that is basically the goodwill. I mean, generally why the share price get increased, because whatever the valuation of the new share value, that is more than the existing share value. Okay, so we are paying a higher price against whatever the net asset we are acquiring. Okay, so that is as per the equity value method. I think it is not tested here. Okay. So impairment you are able to understand once you means whenever you are calculating the net cash discounted cash flow and you are evaluating your business, you find that the net asset value or the carrying value of the asset is higher than the valuation as per the net cash flow. Okay, so if it is higher, then we need to reduce the value of the asset. Okay, so that process is basically the impairment. We means we are impairing the asset. Okay. So here there are certain factors. So it is basically the qualitative assessment. Okay, now you need to understand why we need to think that impairment is required, because business is growing, business is considered as a going concern assumption. Okay, so still why we need to test the impairment. Okay, so sometime what happened, say for I mean we have a certain licenses, okay, or there are certain permission required from the environment. Okay, but suddenly some rule come, or government may decide, okay, particular area is not for the manufacturing unit and we brought the land over there. Okay, so valuation of land immediately goes down. Okay, so if this kind of situation arises or we got the indication, then we need to give a thought. Okay, we need to evaluate like what would be the possibility or what would be the valuation. Okay, I'll just tell you an example. um, like Tata, they brought land in West Bengal for nano project. Okay, for nano project. But because of some governmental clearance, they decided to exit. Okay, so when they purchase the land, the price could be higher. Okay, because I mean everybody is expecting, okay, Tata is coming, so and the Tata is acquiring, so that's why there may be a possibility the villagers may sell the land at a higher prices. Okay, so acquisition of the cost of land is high. Okay, but because of certain rules and regulation, they need to exit. Tata need to exit. Okay, so if this is the situation, after that there is a very limited buyer, so that this land can get sell. Okay, so cost or the value of the land, because we are not able to build the business on this land, plus the land is too huge and no one can buy the land. Okay, so value of the land goes down. Okay, so if it is goes down, even if you are not selling it, okay, still it is an indication. Earlier we supposed to use for a business, but now we cannot run over the business, so that's why the value of the asset may go down. Okay, or we cannot recover the value of the asset. Okay, so in that situation, if I assume Tata may buy with a 10 lakh and now the value is 2 lakh, because now it is a normal land. Okay, so this 8 lakh we need to consider as a impairment loss. Means we need to reduce the value of the land from 10 lakh to 2 lakh. Okay, that is basically the impairment. Okay, so indicator here is because Tata need to exit. Okay, so value of the, we need to go for a testing of the impairment. Okay, if they build a project over there, then maybe it is not required. Okay, unless and until you are not getting a situation or a condition where you are not certain whether you can run the business or recover the value of the asset. Okay, if you are getting any situation, okay, that your capability to recover the value of the asset may go down, then you need to test for an impairment. Okay, so here there are certain factors given, like the cost factors such as the increase in raw material, labor, or other cost. Okay, so I mean, if there is a predominant increase in the value of the cost of raw material, okay, then it will affect the profitability margin. Okay, and because of that reason, value recoverability of the value of the asset may goes down. Financial performance such as negative or declining cash flow. Okay, so it is a regular factor. Once we have a setup maybe for the pager. Okay, demand for the pager goes down because of mobile. Okay, goes down. So this is again call for impairment. Okay, then legal, regulatory, contractual, political, business, or other factors we just discussed. Other relevant entity specific events such as changes in management, key personnel strategy, or customer competition of bankruptcy or litigation. Sometimes what happened means you can understand by reading it. Okay, but see, you are depend on a one large customer, and he bankrupt. Okay, so in that situation, your volume may go down. Okay, this is basically the issue. Okay, so if your existing large customer is not lifting, I mean, not ready to place the order, so value of recoverability of the asset is questionable. So you need to test for a impairment. Okay, industry and market consideration such as deterioration in the operating environment and increase in competitive environment, a decline in the market multiple, or a change in market demand for the and entities, product or services. Okay, so earlier what happened, like mobile operators. Okay, they are very less, or there is a restriction like two operator per state, like this, per state. Okay, but state. But when this restriction remove, so competition get increase. Okay, and because of increase in competition, you cannot recover the amount, or you cannot charge a higher amount from your users. Okay, and because of that reason, again the cash flow get affected, and the value of the asset, means whatever the asset we um, deploy, okay, for giving a service to our, I mean, the mobile operators customer. Okay, so the whatever the recovery we are able to get it from them, that may go down. Okay, and that again call for the impairment. I mean, if you recollect, earlier we used to pay the 13 rupees per minute, but now it is 1 rupees 50 paisa or even free. Okay, so this will affect the recoverability from the customer, affect the cash flow. So we need to test again the impairment. Then microeconomic conditions such as deterioration of a general economic conditions, capital access limitation, or fluctuating in the foreign current exchange rate. I mean, right now the euro, it goes from 80 to somewhere around 104. Okay, so because of that reason, my future EMI, if I have some or future commitment in a foreign currency, get affected. Okay, if someone took a loan in a euro because of less interest rate, say for because if you take a loan of FC in a foreign currency, okay, so then you need to pay 2 to 3% or 4% interest. Okay, but like exchange rate now increased by 20%, like this. Okay, so this will again affect my cash flow. Okay, and because of that reason I need to again test for the impairment. Okay, or corona period arises, I mean this kind of pandemic situation arises. Okay, so then to drive the business, particularly if you see the hotel industry, it is very difficult for them in those in that period. Okay, so again whatever the investment they did, they need to test for the impairment. They need to evaluate whether they can recover the value of the asset through ongoing operation, and if they cannot recover, they need to impair the asset. Okay, so the first thing, there are certain intangible asset having a definite life, like patent, copyright. Okay, and there are certain intangible asset having an unlimited life, but you need to test for the impairment for those asset. Okay, means if the asset have an unlimited life, then we do not require to charge off amortization. Okay, but we need to test for an impairment. Okay, so when testing an indefinite live intangible asset other than goodwill for impairment, it is generally not possible to estimate total future cash flow expected to result from the use of the asset and their disposition. Okay, so as a result, intangible asset with indefinite life is tested for impairment at least annually by comparing the fair value of the intangible asset to its carrying amount. If the asset fair value is less than carrying amount, impairment loss is recognized in an amount equal to the differences. Okay, so we need to test for an impairment like this. Now see how we are going to uh, like test. So optional qualitative test for impairment, then fair value minus net carrying value. Okay, so fair value of the asset, okay, whatever may be the amount, and the carrying value of the asset less carrying value. Carrying value. Okay, so if it is positive, okay, then no need for impairment. No, and if it is negative, then you need to impair. Okay, impair. Write down the asset, amortize new cost, and the restoration not permitted. Okay, so you need to write down the asset, amortize new cost, and restoration not permitted. Okay, so restoration not permitted means I hope you are able to understand the write down of the asset, amortize new cost means whatever maybe the loss arises. Okay, we need to reduce the value of the asset. Okay, and then there is a new cost assigned to the value of the asset which is lesser. Restoration not permitted means if you impair, say for you have an asset worth 10 lakh, because of some rules and regulation you decided to impair with a 2 lakh, so now the asset value is 6 lakh, sorry 8 lakh. But after 3 years, okay, whatever the condition or restriction put by the government, this was removed. This is get removed. Okay, so in that situation, value of the asset may again goes to more than 8 lakh. But in that, if this situation arises, you cannot restore. Like you cannot increase the value of the asset. Cannot increase the value of the asset. Value of asset. Okay. So, I mean, again, we have a value of the asset 10 lakh. Okay. Because of some restriction from the government side, value of the we need to impair with a 2 lakh. Okay. So, my net value is now 8 lakh. Okay. After some period, this restriction get removed by the government. Okay, if this situation arises, okay, so again I can fetch the value of the asset to the tune of 10 lakh. Okay, because the restrictions are removed. But once I impair, I cannot restore, so that is not permitted. Okay, so that accounting standard you need to keep in mind. Okay, clear on this issue? Restoration is not possible. So recording the impairment asset. Okay. So whatever may be the impairment loss, whether we need to treat it as a income from continuing operation or extraordinary item like this. Okay. So this is basically from income from continuing operation. Goodwill impairment, goodwill is tested for impairment at least annually. Goodwill impairment is calculated at the reporting unit level. Okay, now reporting unit. Okay, so reporting unit means if the company has a two division XY, YZ, and ZX, or three division you can consider. Okay, each division has a separate asset, liability, and we are showing it in a segmental reporting as well. Okay, so if value of the asset goes down of this unit, okay, but it will it will not affect, but it will not affect value of this or the value of this. Okay, so we should reduce the value of this asset. Just because here we may get increase, we should not compensate. Okay, so unit wise you need to impair the value of the asset. Okay, that you need to keep in mind. Unit wise impairment required. Required. Okay, so that also you need to keep in mind. And unit could be anything. Means the one department or the like product range. It is like this. Qualitative assessment of goodwill impairment. Okay, so okay, so how I can say? Okay, say for the asset value is 10 lakh. Okay, and chances of maybe how I can say, means there is a change in demand. Okay, chances of change in demand that affect us is 50%. Means I'm giving an example. Uh, we have a one customer who buys 80%, and we have a 20 customer who buys maybe the 4% each. Okay, so if this is the situation, if this customer get failed, okay, so it is more than 50% chances that we are not able to recover. Okay, But from this set, if one or two customer fail, okay, so in that situation, can we conclude that more than 50% chances that we cannot recover? No, because it will affect hardly 8 to 10%. Okay, so if this is the situation, okay, so in that, I mean, whenever we know that one of my customer get bankrupt, then we need to evaluate quantitatively, qualitatively, and we need to see what would be the impact on me. Okay, so if this is the situation, then 100%. I mean, we cannot recover. We cannot, because the customer who is buying from me almost 80% of my turnover of my production. Okay, so to build a same level of customer, it takes time. Okay, so you need to impair. Okay, but if I have a set of 20 customer who are buying the 4 to 5% each, okay, out of that one or two customer get fail, it will not affect much. Okay, so that is basically the qualitative assessment. Quantitative impairment, I mean, we need to calculate, and whatever may be the excess value, or whatever may be the difference in recoverability and the goodwill stand, that is basically the quantitative impairment. Okay, so this is given, I mean, as per the whatever may be the goodwill accounting standard that is adopted by the all companies. Okay, but there is an exception to the public company. Okay, so either they can amortize the goodwill on a straight line basis over 10 years, or less than 10 years, it can demonstrate that other useful life is more appropriate. And you need to whatever you are doing, that we need to disclose. Okay, so what happened generally, I mean, all over the world, goodwill is not get amortized. We need to impair as and when situation arises. Okay, we need to test for an impairment, and then as and when situation arises, I mean, the recoverability is, if the recoverability is less than the carrying value of the asset, then we need to impair the goodwill like this. Okay, but there is an option given for a private company as per the US GAAP, that they can amortize the goodwill over 10-year period. Future business combination, additionally private company. Okay, so say for, this is also the example, private company, they decided to amortize goodwill. They decided to amortize the goodwill. Okay, but still, if some situation happened which may call for, if some situation happened which may call for, like they amortize the goodwill by 10%. Okay, and some situation happened which may call for a situation where the asset value may go down less than 50%. Means it is basically amortization plus impairment. Okay, so is it possible for them? Means it is either they need to amortize over 10 years period, or they need to test for a impairment on a reporting period. Okay, is it the situation, or they can do both simultaneously? Okay, so they can do both simultaneously. Okay, so they can amortize as well as they can test for the impairment on each reporting date. Okay, so they can do simultaneously. Okay, now we need to see the practical evidence. Omega Inc. has a two reporting unit, Alpha and Beta, which have book value including goodwill 5 lakh and 6 lakh 750,000. Alpha and Beta asset value including goodwill. How much? 5 lakh and 6,75,000. Okay. Alpha report goodwill of 50,000 and Beta report goodwill of 75,000. As a part of the company's annual review for the goodwill impairment, Omega determined that the fair value, including goodwill of Alpha and Beta, 480 and 700. Means they tested for the impairment and they realized now the next asset value is 480 and here it is 700. So how much we need to impair? Means it is minus 20,000 and plus 25,000. Okay. So here there is no need for impairment because fair value is more than the carrying value. Okay. This 20,000 we need to impair. Okay. Because alpha's fair value is less than book value. There is a goodwill impairment, but beta goodwill is not required. Okay. So exactly we just need to impair the 20,000. This one. Okay. Research and development cost. Okay. Anyone has any doubt till now? Goodwill impairment?
No, sir.
Okay. Then the research and development cost. So the only acceptable method research and isn't direct charge of two expenses. Okay, I tell you something. Okay, R&D cost. Unless and until whatever the R&D we are doing, okay, so technical feasibility is not proved, we need to charge off two expenses. Okay, so like at the beginning, means whatever the raw material I'm purchasing or whatever the man hours I'm booking on the R&D cost, okay, that is basically um, considered as a expenses. Okay, if I buy some exclusive asset for R&D project, okay, whether I need to capitalize it or whether I need to expense out. Any guess? If I buy the asset for a R&D purpose and that asset don't have an alternate use, so whether I need to charge off because asset we generally need to capitalize. I brought the machine for an R&D purpose and I don't have any other alternate use. So whether I need to expense out or we need to capitalize. Any guess? I mean, it is simple. You can say, sir, it is expense out, or you can say you can capitalize. So, any guess?
Expensed, sir.
Yeah, we need to expense out. Okay, because there is no alternate use. Okay, see, keep in mind, because we are not certain at the time of incurring expenses whether we can derive the benefit or not. Okay, and that's why unless and until technical feasibility generated, or we can conclude, okay, we can generate some future benefit, then and only then we can capitalize any cost incurred for the R&D. Okay, if we are not sure, okay, and particularly at the beginning of the R&D, we never sure that particular whatever the cost we incur, whether this will give us a benefit or not. Okay, so any exclusive asset for a R&D project, that you need to expense out. Okay, if the asset has an alternate use, then you can capitalize. Means we acquire the asset for the R&D purpose, but if R&D activity, even if the R&D activity gets failed, we can use the asset, then you can capitalize. Okay, so this you need to keep in mind. Means in exam you may get the question. Okay, generally, because we are aware, generally asset we need to capitalize, but this is an exception. Okay, and if the asset has an alternate use, then we need to capitalize. This is an exception for the accounting of a research and development cost. So this way you need to keep in mind. Okay, then the second one is basically if you are doing an activity of R&D on behalf of other party. Okay, so in that situation, it is not an expense for you, it is just like a cost of goods sold. Okay, so then you can capitalize as an inventory, because you are going to recover this amount. Okay, and the third, if you purchase the company, okay, and there is a certain R&D amount which is capitalized, then you need to carry it as a capitalization. One more question here. If you purchase company, okay, at the time of negotiation, because that company may expense out R&D costs. R&D cost, but in purchase consideration, because they did some work, purchase consideration, okay, they consider the cost of R&D expenses, or they charge cost of R&D expenses to buyer. Okay, means buyer is paying for whatever the net asset acquired plus whatever the R&D cost incurred to the date. Okay, R&D expenses to buyer. Okay, so in that situation, whether he is capitalized or expense out. Any guess? Means in process R&D acquired by the buyer. Okay, at by paying a separate cost.
It should be expense.
No, it should be capitalized. See, try to understand whatever the excess amount paid over the fair value that we are considering as a goodwill, or I can say the intangible asset. Out of this, if I am aware the particular expenses is related to the R&D, then I need to capitalize this as an R&D cost. Whenever the technical feasibility get failed, okay, at that time we need to charge off. Okay, so that is also the exception. Okay. Item not considered research and development. Okay. So routine periodic design changes to old product or troubleshooting in the production stage that are manufacturing cost and not R&D expenses. Means whenever you are manufacturing any machine, I mean you do require to customize as per the customer requirement. Okay. So that you need to charge off. I mean that you need to consider as a routine R&D, routine design expenses. Okay. Then second is marketing research. So whatever the expense out you are doing for the research activity for the marketing purpose, that also you need to expense out. Quality control testing, it is a normal, I mean day-to-day operation, so you need to expense out. And the reformulation of the chemical compound, so that is also you need to expense out. Okay, so we will take this example. So whether we need to expense out or not. So material used in research product. So whether we need to expense out or four lakh. Okay, so that we need to expense out. Then equipment acquired that will have a alternate future use in failure of research and development projects. So as we already discussed, this we need to capitalize. Depreciation on above equipment, that we need to consider as an expenses. Okay, because depreciation is basically for a particular period. Okay, and for that period we use this asset as a use for the research and development project. So that's why the depreciation we need to consider as a expenses. Personal cost of a person involved in research and development project, that also we need to expense out. Then consulting fees paid to the outsider for research, and that is also we need to expense out. And indirect costs reasonably allocated to research and development projects. So that also we need to expense out. Okay. So like out of this, if you see, the only asset which we need to capitalize, which has an alternate use, but depreciation on that asset for that, I mean the for the period for which we utilize the asset for a research and development project, that we need to consider as a research and development expenses. So, I mean, computer software developed to be sold, lease, or license. So that we need to consider as our. I mean, we need to just like the way we are doing an accounting for the inventory. So expenses, cost, planning, design, coding, and testing incurred until the technological feasibility has been established for the product. Capitalized cost, coding, testing, and producing product master incurred after the technological feasibility has been established up to the point that the product is released for the sale. And technological feasibility is established upon completion of the detailed program design or working model. Okay. So whatever the cost we incurred, okay, till establishment of establishment of technological feasibility. Okay, that we need to expense out. Okay, and after that, whatever the cost incurred, that we need to capitalize. So amortization. So that is basically on the basis of, I mean, it is just like a utilization method. Okay. So what say for I have an expectation that over the period of that software I may generate a revenue of 10 lakh, and particular year I have generated the revenue of 2 lakh. So we need to, it is basically the 20%. So 20% amount I need to charge off in a particular period. So total amount capitalized multiplied by the current gross revenue for the period, total projected gross revenue for the period. Okay. And the second method is straight line. So whatever may be the total capitalized amount multiplied divide by whatever may be the economic life. So this way we can amortize the capitalization software cost. So cost incurred to actually produce the product are product cost charged to the inventory. Capitalized software costs are reported at the lower of cost or market wherever the equal to. Okay. So like what happened initially, whatever the software we built, okay, so that we are going to capitalize. But whenever we are preparing the copies of that software or whatever may be the maintenance or other expenses, that we need to consider as a expenses for the period, okay, or that we need to consider as a, I mean, we need to capitalize as an inventory. Okay, so if you see here, so up to technical feasibility we need to expense out, and after that we need to capitalize. Okay, so resell product for the sell, so amortize the beginning expenses, means whatever the incurred till here. But after the capitalization completion, so whatever the expenses, means duplicate packaging or any copies we are creating, that we need to consider as a inventory cost of goods sold. Okay, so this way we need to do. Means up to the technical feasibility established, whatever the expenses we incurred, that is already charged off, so there is no need for further consideration on it. Okay, but whatever the capitalized amount, that we need to amortize over the useful life of the asset or the proportionate revenue, and whatever the after capitalization, whatever the cost incurred, that we need to consider as a inventory cost. Now, whatever the software cost we develop internally or often only for the internal use. So, expenses cost incurred for the preliminary project state and cost incurred for training and maintenance. These are all the expenses. Okay. And the capitalized cost is basically after the preliminary project state and for upgrade and enhancement. Okay. So, that we need to capitalize. Okay. So, for example, means again keep in mind whatever may be the cost incurred up to the technical feasibility in any situation, that we need to expense out, plus training, because these are all operating. Okay, but any cost incurred after technical feasibility plus any amendment, or I can say updates, okay, that you need to capitalize. Okay, and that you can charge off on a straight line basis on a remaining useful life of the asset. Okay, so here you cannot charge off on the basis of revenue, because we are develop the software for our own internal use, so you need to amortize over the straight line method. Okay, revenue recognition. If software previously developed for internal use is subsequently sold to outsider, proceed received should be applied first to the carrying amount of the software and then recognized as a revenue. So whatever may be, I mean, so you develop for your own purpose, and after subsequently you decided to sell. Okay, so in that situation you need to whatever may be the capitalized amount. Okay, so first you need to charge off. Say for you, you have a capitalization or carrying amount. I mean, after amortization of 1 lakh, and you sold this software to the 1,50,000. Okay, so you need to first 1 lakh you need to compensate against this, and the remaining 50,000 you can charge off to revenue, or you can treat as a revenue. Okay, so this is basically the carrying value. This is basically the sell value because we decided to sell subsequently. Okay, so whatever may be the excess over the carrying value, that you need to recognize as a revenue. Crypto asset represent the digital value or right. The value of the right or the digital asset are created or reside on a distributed ledger such as blockchain. Okay, so that is also considered as a long-lived, indefinite-lived intangible asset. So you need to, for crypto asset, you need to recognize at a fair value on each reporting date. Recognize at a fair value. And the changes from reflect the current period net income. And whatever may be the changes that you need to report it in P&L, net income. Net income. Yeah. So, any doubt till now? Okay. Now the revenue recognition. Okay. So generally, when we need to recognize the revenue, I'll give an example. If you make an invoice to customer, but not delivered the product, can you recognize the revenue? Any question, any doubt? Any guess from anyone's side? If I make an invoice to the customer but not delivered the product, if I have not delivered the product, that means I have not fulfilled my obligation. Okay, so if this is the scenario, okay, what does it fulfill my obligation? So if this is the scenario, what would be the situation? I cannot recognize the revenue. I can recognize the revenue only when I can recognize the revenue only when, okay, I am complete entire part. Okay. So unless and until if I have not fulfilled my obligation, even though I invoice to the customer, I cannot recognize this revenue. Okay. So I need to reduce the sales value because I already raised the invoice and park this amount to the deferred revenue. Okay, because while doing an invoice, I may pass an entry customer account debit, okay, to sales account credit. But as I have not complete the performance obligation, so I need to reverse sales account debit and the deferred revenue account credit. Okay, and this is basically the part of current liability. Clear? So first we need to evaluate the contract with the customer. What is my performance obligation? Then if I have a separate performance obligation in the contract, then I can recognize the revenue with the specific performance obligation. Then I need to determine the transaction price, allocate the transaction price to the separate performance obligation, and then recognize the revenue when or as the entity satisfies each performance obligation. Like I need to make a design, then manufacturing, or design manufacturing, and the third one is basically the commissioning. Okay, if in the contract it is given once you complete the design you are eligible to get the 20% amount. Okay, so if it is given in the contract, okay, so then I can recognize the revenue for a 20% when I complete the design. Then in the contract if it says we complete the manufacture and then it is a 40% I can get it, then I can recognize the revenue at this stage. And if the contract says once I complete the commissioning I can get the balance 60%, then full invoice I can recognize or the sale value I can recognize over here. Clear? Okay, one more question. If this 20%, because you need to understand the practical situation as well, we are getting against submission of the ABG. Okay, so I mean the point here it is not given, but this should be my unconditional right. This should be my unconditional right. Okay, so if I giving an ABG, that means I'm getting a money, but with certain conditions. So again, I cannot recognize the revenue. Okay, so if I'm getting any amount as an advance or down payment, or against bank guarantee, that cannot qualify for the recognition of the revenue. That also you need to keep in mind. Okay, several times this question may arise in your practical life, because you getting an amount and you already did the invoice, then why you cannot recognize the revenue? Okay, so if there is, if any amount we are receiving, this is with certain condition, then unless and until this condition is not get fulfilled, you cannot recognize the revenue. That you need to keep in mind. Okay, any doubt here? So this 5 step you need to keep in mind. The first, you need to identify the contract with the customer. Then you need to drill down what are the separate performance obligation given in the contract. Okay, and then determine the transaction price for each contract. If you have a consolidated transaction price, then you need to allocate the transaction price to each separate performance obligation. And the last, once you complete your performance obligation, then and only then you can recognize the revenue. Then construction contract revenue recognized over time. So revenue on a construction contract is recognized over time if any one of the criteria below is met. So the entity's performance creates an enhance an asset. Example, work in process that the customer control as the asset is created or enhanced. Then entity's performance does not create an asset with alternate use to entity, and the entity has an enforceable right to receive the payment for the performance completed to that. Okay, understand. If you are building, I mean, we can say, doing a project at customer site, or take an example of construction of building. Okay, so whatever the value addition we are doing to building, this asset controlled by the buyer. Okay, seller don't have any control here. Okay, so entity performance create or enhance asset that the customer control as the asset is created or enhanced, so you can recognize the revenue. See, there is no need for transfer of property. Okay, it is already, we are building, we are constructing a building on the customer or the buyer's place. Okay, so ownership automatically get transferred, so you can raise the invoice in this situation. And the entity's performance does not create an asset with an alternate use to the entity. Okay, so the entity has an enforceable right to receive the payment for performance completed to date. Okay, so what happened, you cannot use for other purpose. Other purpose. Okay, so in that situation, if the contract says up to particular level, if you do the value addition, then you have an enforceable right to receive the payment. In that situation, you can recognize the revenue. Okay, so what happened, if you are doing something which is in your control, then you may not recognize the revenue, because you are not transferring the property. But if you are doing something at a buyer side, okay, so he has a control over the asset. So whatever the value addition you created and created for that, if you have enforceable right to receive the payment, then you can recognize the revenue. Are you able to clear my point? Okay, we can take this example. Tanner Company is building a multi-unit residential complex. The entity enters into a contract with a customer for a specific unit that is under construction. The contract has the following terms. Customer pays non-refundable security deposit upon entering the contract. So in that situation, the first security deposit, okay, so that we need to consider as an obligation, even though it is non-refundable. the customer agrees to make progress payment during construction. So whatever the progress payment we are receiving, we can recognize as a revenue. If the customer fails to make the progress payment, the entity has a right to all the consideration in the contract if it completes the unit, and the terms of the contract prevent the entity from directing the unit to other customer. So we cannot use that for the other customer. So in that situation, we can recognize the revenue over completion of the performance obligation. Is satisfied over time or at a point in time. The performance obligation is satisfied over time because the unit does not have an alternative future use to the entity, because it cannot direct to the other customer. Okay, and the entity's performance create an asset for the customer which controlled by the customer, and because of the terms of the contract prevent the entity from directing the unit to the another customer. One point we need to take here. Um, Recognize revenue over a period of time and at the point of time. Okay, at the point of time means once we complete everything. Okay, then and only in that situation we need to recognize. Okay, so once we complete everything, at that time we can recognize the revenue. And second is basically on a part basis. Okay, so we can recognize the revenue on part basis only when it is agreed in the contract that we are able to get or we are able to receive the progressive payment. Okay, and the asset is controlled by the buyer or the customer. So in that situation, we need to recognize. We can recognize the part revenue. Okay. Okay. So then we need to see the calculation. Okay. So we can take a 15-minute break here and then I'll continue. Okay.
Okay, sir.
Yeah. Hmm? अरे and
hello, good morning. Is anyone there?
Yes, sir.
So the thing is that there is some issue at Sumit sir end, some technical issue has happened. Because of that, he is trying to join back also, but not possible. So he also suggested that we can have maybe 2 hours in the night. Is that okay? Because continuous 3.5 hours will also become too much. So we could have maybe 1 hour in the morning. Now we consider 1 hour and 2 hours we can have in the night. So just think about it and I'll message in the group also. So accordingly you can let me know. Okay, because that's how we can then continue. Okay.
Sir,
So
what time
currently
will,
we will consider this as 1 hour and we will close the session.
sir, what time will it be at?
8 to 10 in the night. Okay, let's message that in the group and see the response. Okay, currently I am closing the call uh, after 1 hour for today's session. Okay,
Okay, sir.
thank you, thank you.
सीधा क्यों पूछती है? हाँ सुरेखा भाई, उल्टा और सीधा क्यों पूछती हो?